Welcome to your first narrated PowerPoint in managerial accounting. Interestingly, we're starting with financial accounting topics. The Statement of Cash Flows, Chapter 13, and Chapter 14, which is financial statement analysis, are actual financial accounting topics that we just don't have room to cover in our financial class. Many of you may have covered it if you took accounting for financial accounting at a different school. But at the Citadel and many other universities, there's a lot of content that's put in the managerial course related to financial accounting. So the Statement of Cash Flows is the fourth financial statement out of the four studied and the four that are required by generally accepted accounting principles. We study this as we anticipate doing an annual report project. The other three financial statements, hopefully, they come to mind: income statement, balance sheet, statement of retained earnings, also known as the Statement of Stockholders' Equity. The Statement of Cash Flows, however, is unique because it is prepared on a cash basis. Obviously, the name gives it away, but the other three financial statements are prepared on an accrual basis. That means that it includes revenues and expenses that haven't been received in cash. So this financial statement is extremely unique and extremely helpful in analyzing a company. I hope you find these narrated PowerPoints helpful, and let me know if you've got any feedback on them. So let's get started. First, let's look at one. This is Amazon's for the year 2011. Okay, it gives us a totally different picture than any of the other financial statements because it's done on a cash basis. All the other financial statements are prepared on an accrual basis. If you need to, go back to your 211 course, look at the definition of accrual accounting. It's in one of your first 3 or 4 chapters. And remember that accrual accounting means that you record revenues even though you haven't received them in cash. You record expenses even though they haven't been paid. So the other 3 financial statements are done on an accrual basis. That's ACCRUAL. The Statement of Cash Flows is on cash. We're looking at how much cash came into and went out of their bank. We're going to divide it into 3 categories: operating, investing, and financing. Most importantly is kind of unusual. The answer is at the end. So in this example, Amazon for the year 2011, their cash went up $1.4 billion from the prior year. The prior year was $3.7 billion. The end of the year, they had $5.2 billion in cash. So their cash increased, as they show here, an increase in cash of $1.4 billion. And we're going to talk about how this is calculated and the information you can use from these financial statements. Okay, so first of all, we're going to use this information from a statement of cash flows to see how well a company can generate cash. And as you note here, there are 3 ratios. We'll do a full chapter of ratio analysis in Chapter 14, but it's good right now for us to cover the cash flow yield ratios, just like you've covered the profit margin and the current ratio, debt to equity, some of those other ratios in your 211 class. Well, here's some more ratios to be able to analyze a company's success. The first thing to note is that these are coming from the cash flows from operations. And they're measuring how well a company can pay their bills on time and if they've got enough cash sort of for an emergency. And we're looking at cash generating efficiency, how well our cash coming in and our cash going out from operating activities will help us to be able to analyze the success of a company. I've always compared ratio analysis to statistics in sports, whether it's RBIs or yards passing, yards rushing, number of first downs in a quarter. So these ratios give us similar information. Our first ratio, here's the formula. You'll have access of this, of course, whenever you're taking the exam. And here is Amazon for the year 2009. We see that the cash flow yield is 3.7 times. That means how much cash based on the amount of net income do we have, can we yield? And they, based on their net income, they can generate 3.7 times more cash from operations, which is a positive thing. Our next is cash flow to sales. Given the fact that they pulled in $24 billion worth of sales, again, remember, this is on an accrual basis. This ratio shows me that they were able to generate $3.2 billion in cash flow. And that gives us a ratio of 13.4%. Our final ratio is cash flow to assets. We take average total assets. That's adding up beginning of the year plus the prior year, dividing by 2. That information's up here. We find that they have a cash flow to assets of 29.8, about 30%. That means that given $11 billion worth of total assets, they were able to generate about 30% of that in cash flow. So, quick reminder, these ratios don't mean anything by themselves. I don't know if 30% is good or bad. You have to compare it to prior years and to other companies. Just like sports statistics, where you have to compare yards rushing from one team to the other. So whenever we look at ratios in a company, we have to compare one company to the next. So these are the 3 cash flow ratios we'll be studying. Now, let's talk about these 3 divisions and the fact that we're dealing with something called cash and cash equivalents. Okay, here's our definition. Cash is just what you would think of it, bank accounts, money. Cash equivalents are investments that we have that will mature in 3 months or less. It's an important definition to remember. And so the statement of cash flows says, okay, what's going on with their cash and cash equivalents? Out of these 3 categories, where did the cash and cash equivalents get generated from, or where did we spend it? Remember again, huge importance. The other financial statements on the accrual basis, and they include accounts receivable and accounts payable, but this is on the cash flow basis. Finally, the cash equivalents concept repeated here, because that's a new concept for most students. Okay, we're going to move to a definition of these 3 categories. First, operating activities. Let's look at the most important ones. Cash coming in from operations has to do with what we're selling. So this is the primary cash inflow. That means most of the deposits for a business related to operations are the money that they get from selling whatever their product is or whatever their service is. If it's Boeing Airlines, their product is selling aircraft, or Boeing also does repairs and maintenance, and so that would be part of the receipt from the sale of services. Cash outflows comes from expenses related to these sales. For inventory, other expenses, insurance, rent, etc. And then of course there's always some other pieces that go into these categories. But for the most part, when we're looking at operating activities, these are the cash inflows. That means the deposits go here. This is the plus side. And these are the cash outflows. This is the negative side. And operating activities has to do with what the company's main purpose is. What are they in operation for? Investing activities. This involves, for the most part, I'm going to circle the most important part, selling long-term assets. So let's say that a company like Boeing decides that they no longer want a warehouse and they sell it. That cash that comes in will go in the investing section. Cash outflows, expenses based on the purchase of assets. Right now, if you're familiar with Charleston, the Boeing facility in North Charleston is actually building a facility so that they can paint the aircraft, and it's costing them quite a bit of money, hundreds of millions of dollars, and that expenditure or that cash outflow is a purchase of an asset, a fixed asset. Investing activities are important to see if a company is expanding, and if so, if they're expanding, they're going to be spending a lot of money. If they're trying to sell off some of their things, then they're going to be having a lot of cash flow coming in. Okay, financing activities. This tells us, where does the money come from to finance this organization? And so most of the time we're looking at money that they've borrowed. So if cash is coming in from borrowing money from a bank, it goes here. If cash is going out from repaying a loan, it goes here. Notice there's a few things like excludes interest, because if you noticed earlier, interest goes in the cash flows from operations section. Is the operating, investing, financing, and then non-cash investing and financing transactions. If you look in your textbook, your ebook, or your loose leaf, you'll see a full statement of cash flows, and sometimes that helps to watch as you're watching and listening to this audio. Okay, there are two methods of preparing the operating division. Financing and investing only have one. Under operations, you've got to pick one. The first one is called the direct method. It's not used very often. And here's an example of what the direct method looks like. Most companies use instead what we call the indirect method. And we're going to focus on this one. The indirect method lists only items to reconcile or convert accrual basis income to cash basis statement of cash flows. And that's what we'll be doing in this study of the operating activities indirect method preparation. And most people indicate that they prefer the indirect method. It's easier to prepare. By the way, both of them come up with the exact same cash flows from operating activities. So it's a company's choice. Okay, we're going to look at these three preparations: operating, investing, financing. You'll find this one's a little more difficult. These two are pretty simple because you're just following the cash. So let's move forward to studying how to prepare the operating activities section of a statement of cash flows using the indirect method. So when we start to prepare the indirect method on the statement of cash flows, we start with the income statement of the company. We're going to use a company called Eureka Company, 2014, and you can see that they have revenues and expenses, just like you learned in your financial accounting class. Here's revenues and cost of goods sold and gross margin, and then there's all kinds of other expenses to come down to net income. We need to reconcile this net income to see what it looks like as instead on a statement of cash flows. And here's the actual statement of cash flows for Eureka Company. Starts with $16,000 in net income from that income statement, and then it ends up that this company actually brought in $30,000 in cash flows from their operating activities, also known as from operations. These are all the reconciling items that we will discuss, some of them in more detail than others. Depreciation does not involve cash, so we add it back. Gains are in the wrong category. They go in the investing section, as do losses. And then all of these areas are ways for us to show the reconciliation of cash of income from the income statement to net cash flows on the operating section. So it would be as if you explained to someone, why have you got $30,000 in the bank and yet your income statement shows that you only made $16,000? What's the deal with that? And you would explain to them, well, because I have depreciation expense subtracted on my income statement and I didn't have to pay cash for that. So that's kind of the way that this looks. Depreciation, amortization, and depletion are the first item that we add back in a statement of cash flows. Why? Because depreciation does not involve cash. Now, this may require you to go back to last year's course whenever we discuss depreciation expense. And you remember that it's the allocation of an asset's cost over its estimated useful life. Does not involve cash. The cash went out when you bought the asset. And so as a result, on the statement of cash flows, we add. And if you look back at the statement of cash flows, you'll see that this is a plus. It's added back because it never involves any outlay of cash. Gain on sale of investment. This company shows a $12,000 gain on sale of investment, and the cash flow analysis is that it has to be subtracted because it's in the wrong place, and it should instead be in the investing section. It's a gain. It was a plus on the income statement, so we subtract it off when we do the cash flow analysis. Loss on the sale of plant assets is a similar idea. It's in the wrong section. It goes instead on the investing activities section of the statement of cash flows. So you add back that loss, comparing and reconciling net income to cash flows, to be able to show that it's going to go to another section and you'll deal with it at another location on the statement of cash flows. Looking at the rules related to changes such as this, let's look at what I call a cheat sheet. You'll have access to it while you're taking your online exams. As a reminder, the non-cadet honor code indicates that you are not allowed to use other individuals or to work together on exams, but you can use your books and your notes and the PowerPoint. So here we have the rules for reconciling items from the income statement that do not affect cash flows. Depreciation, expense, amortization, depletion, all added. Losses are added. Gains are subtracted. So this helps when you're preparing your statement of cash flows. When you're looking at the changes in current assets and current liabilities, this also will help. Let's see if we can just grab one other one. Accounts payable. Let's see if we can do some logic. For some of you, it helps to not have this cheat sheet so much as it does to understand the logic behind it. Accounts payable are added to net income to reconcile to cash, because that means that on your income statement, there was an expense that was included that made your income go down. But since you haven't paid for it yet, then you still have the cash. And therefore, whenever your accounts payable go up, that means that you actually haven't paid for items and you've got the cash in your cash flows from operations compared to the net income, which is what we're reconciling. Yes, I know this is a very complicated concept for many, but hopefully it makes sense as you study this financial statement more. For those of you going to intermediate, you'll see a lot of this. So let's try this one. We start out with net income of $35,000. How do you calculate cash flows from operations based on these four reconciling items? I would suggest that you pause this tape, see if you can do a calculation. We'll show the answer in a minute. Okay, hopefully you're back. I know a lot of people say, oh, just show me the answer. Let's look at the answer. Net income of $35,000, always add depreciation. Subtract out the gain because it's going to go into the investing section. Add the accounts payable because that means that there are expenses the company didn't pay for that were subtracted from net income. Well, that's a good thing for our cash flow, not a good thing for our income statement. And if we had a decrease in accounts receivable from last year, that also gets to be added. That means that net income of $35,000 for this business actually generated $50,000 in cash flows from operations. Okay, let's move on to investing and see where we are with the investing section on the statement of cash flows. Okay, let's talk about the investing activities. Much easier process. It's nowhere near as detailed There are not two methods, there's only one method. So let's see what we can do as far as the investing activities go. Okay, we follow the cash. They bought something. When you buy something, your cash goes down. They sold something, cash goes up. They bought something that qualifies in the investing category, cash goes down. They sold something, cash goes up. Just as a quick reminder, these are the two areas, this one and this one, that were actually found on the statement of cash flows in the operating section, and we had to move them to the investing section. So when we did so, we're going to address them now since they are investing activities. One more item, we've got some bonds issued at face for non-cash transactions, and these non-cash transactions will be found at the bottom of the statement of cash flows. So it's not actually part of investing, even though it is, because they bought plant assets. Again, that's similar to factory assets. Okay, purchasing $78,000 of investments, follow the cash, and we see right here, cash goes down. Remember from your financial accounting class, a credit to cash means cash goes down. So if you notice here, it's subtracted. Let's go to the next one. These are much easier. Cash goes up because we've debited cash, but it also says we sold something, and in exchange we got $102,000 worth of cash. We get to deposit that into our bank account. And that's a plus. Next, we purchase plant assets for $120,000. Follow the cash. Cash goes down, credits mean decreases. On the statement of cash flows, we'll show a purchase of $120,000. Here we have a sale. Lots of details here. Follow the cash, $5,000. And when we analyze this, it's a sale, so we get to add it to the statement of cash flows investing section. Positive cash inflow, investing. Okay, let's look at financing. And remember again, cash inflow means a deposit of money. Cash outflow means money spent. Okay, bonds payable. In this example, we have bonds payable of $50,000, but the cash is an outflow. It looks like they paid off some bonds. And so when this happens, the analysis is that cash went out because a credit to cash. So in the financing section of the statement of cash flows, we'll show a subtraction. Okay. Common stock, follow the cash. A debit to cash is positive. This positive debit to cash is going to be an addition on the statement of cash flows. This is a plus. So the analysis here, just to pause for a minute, says cash as a debit means a deposit. It's added, and the reason it's added in the financing section is because transactions related to the issuance of cash go in the financing section. So here we have our final statement of cash flows. Pretty huge here. Take a look. Let's start off with the Eureka Company. We've got operating activities up here. Then we have investing activities here. We have financing activities here. They had net cash flows of $30,000 coming in from operations, an outflow from investing of $91,000, and as we look at the details, we can see that's because they bought $120,000 of factory equipment, and they also bought some investments for $78,000. And then when we look here at the cash flows from financing, it looks like this big issuance of common stock is where most of their cash came from in the financing department. Yes, they repaid some bonds here, and they paid some dividends, and they purchased some treasury stock, but most of their money came in from here. So when we summarize these three categories right here, they come up to $32,000, and that is the amount of the increase of cash from the beginning of the year to the end of the year of $32,000, and that is our answer. So here we have a completed statement of cash flows on the indirect method. Last thing I want to show you is what we talked about occasionally occurs, and this is a schedule of non-cash investing and financing activities right here. And it shows that they issued bonds payable for plan assets or fixed assets, sometimes they're called. So what's the summary here? Eureka Company, their cash went up $32,000. It came from operations. They spent money on investing. They got money in from financing because they issued stock. You can look at the details in here through this column. Additionally, this shows that even though their income statement showed them making $16,000, they actually got in $30,000 of cash because of all of these accrual basis net income to cash basis cash flows. All of these reconciling items are what caused us to have a difference. So while it seems to be a little tricky whenever you look at the way this rolls, see if I can erase all these so we can look at it one more time. It's really not if you look at the big picture. So what do you need to remember this for? I think the biggest piece is that you're going to be analyzing a live annual report on your annual report project for this course. And the statement of cash flows is one of the most important financial statements out there. And this is a good way for you to understand where the company's cash comes from and where it goes. And if I were to analyze the Eureka Company, I'd look at it this way. Yes, strong cash flows from operations. Looks like they bought a lot of inventory, so they must be expecting to increase next year their sales. It looks like they're expanding because of the purchase of plant assets. Looks like they're investing in the stock market. They've sold some common stock to help in the financing area. Their cash went up. By the way, just for your information, cash going up or down isn't necessarily a good or bad thing unless it's continually going down. And this is what their cash flow picture looks like, contrasted with the other three financial statements prepared on the accrual basis.